So, as we wind down, let's go over one of my other favorite slides. I guarantee you the stock market goes down. Last year, I told you when the market was down 11, 12% on this very night that we held our State of the Economy, that the market, won't stay down forever. This is a slide that shows going back 37 years. The gray is the average return for the entire calendar year of the stock market. As you can see, stocks are up, stocks are down. And out of those 37 years, stocks were up 28 out of the 37 years. I always say stocks are up more than they're down. But investors kind of get a little panicked, knee-jerk reactions, going back to that slide of investors managing money on their own, because there's volatility. Volatility is when the stock market swings from peak to trough, high to low. The average from peak to low is 14.2%. That's how much the stock market swings in any given year, going back over the last 37 years. Last year, the first 6 weeks, it was down 11%. That was the worst of it. But as you can see, there's other years, down 12, down 7, down 6. You get the gist here that stocks go up, stocks go down, they'll swing. That'll never, ever change. When that happens, this is where we take advantage of volatility. That's when you'll see us make some changes in the portfolio, maybe something that was too expensive for us to buy into when the stock market was high. When that stock market swings like this, you'll see us take advantage of those low prices. We always want to try to buy low, sell high. You'll see us get in and out of different areas, and volatility is your friend if you look at it in the right way. Stocks long-term have been a great performing asset class. A difference, Ryan went over what a difference a year makes. So in 2015, I'm having trouble with my pointer. In 2015 compared to 2016, 2015 large cap stock indexes were only up 1.38%. 2016, they were up almost 12%. What a difference a year makes. Small cap in 2015 down 4.5%. In 2016 up almost 22%. International holdings, 2015 down almost 1%, 2016 up 1%. As Marty said, we've been hanging in there with international holdings. They haven't been our favorite place to be. We know why we're invested in international holdings, and hopefully they'll break out. We're very underweight. We love the U.S. stock market. We don't foresee that changing anytime too soon, so we'll continue to be overweight the U.S. stock market. If you look at emerging markets, 2015 down 15%, 2016 up 12%. I remember last year people were asking us during this presentation about their emerging market holdings because they just came off part of that, your returns, having that money that we have invested in emerging markets being down 15% isn't good. But if we sold out because we were down 15%, we would have missed out on an 11 to 12% swing in 2016. Bonds, the same thing. In 2015, the U.S. bond index was up about 0.5%. 2016, up almost 3%. Commodity index in 2015, down 25%. In 2016, up 12%. And then you can kind of get an idea of the year-to-date percentages. Our U.S. stock holdings are doing very well compared to international holdings. Small caps are really, we're getting more and more into the small to mid cap. You probably saw us add some dividend paying small to mid cap ETFs in the portfolio. And one, we love dividends. If you look at stocks over time, the average return is 10 to 12%. Almost 4% of that 10 to 12% comes from dividends. So right now we have 20% of our equity holdings invested, 20 to 25% of our equity holdings invested in dividend paying stocks. So dividend paying stocks were kind of overweight right now. We like those dividends, why we wait for everything else to happen. This is another one of my favorite slides. This is the third favorite slide. And I'm just going to kind of point. This is a 1-year holding period. You can kind of see, thank you, Frank. You can kind of see, you know, the best year, this goes back to 1950. The best year in the stock market was up 47%. The worst year was down 39%. That was 2008. Everybody remembers that time for the most part. Everybody in this room remembers that time. Bonds over the last, over these 66 years, your best return in the bond market was up 43% in any given year. Your worst year, down 8%. And if you had a 50-50 portfolio, 50% stocks, 50% bonds, your best year up 33%, your worst year down 15%. So what I'm going to try to point out here is the next 3 stages are 5-year, 10-year, 20-year rolling periods. So just think of how many 5-year rolling periods there are beginning in 1950, 1951, 1952. You get the idea. Same with 10 and 20-year rolling periods. When you look at stocks over time, stocks aren't as crazy as that 1-year holding period, which is why we say no investor should own stocks if they need their money over the next 1 to 2 years, because they're taking too much risk. Can you imagine having your child's college fund invested in the stock market, and then all of a sudden 2008 comes along and you lose almost half the value? What do you tell your child? You can only go to college for 2 years, not 4? So when you need your money over the next year or two, you really don't want to have it invested in the stock market. And this is something that we really take pride in protecting our clients. Any of our clients that need money, we point this out and we have that money set aside. So over time, stocks isn't as bad of an asset class. Bonds are also an asset class that a lot of people flock to for safety, but as you can see, bonds don't always make money either. So having a diversified portfolio is usually pretty good. And when you look at the average return going back to 1950, the average return in stocks is 11.1%. The average return in bonds is 6%. And a 50-50 portfolio, 8.9%. So our summary, to wrap things up. There's always going to be volatility. That's not going to change. Upside volatility, downside volatility. It makes some investors nervous. We don't get nervous. We will never panic with volatility. We'll use it to better manage the portfolios, and we always beg all of you as clients, if you get nervous, call us, and we'll talk you through it. We don't always have the answers, but we know we're not going to let you shoot yourself in the foot, financially speaking, before we're kind of shaking you and talking you into what you should be doing. Not think with your heart. We always want to be thinking with our head, with information. We have a strong labor market and rising wages. One of the reasons why the Fed more than likely wasn't raising interest rates in March after the January jobs report is we put a lot of people back to work, but the hourly wages weren't growing, and they have been growing over the last several months. This is something that's as important, having more people go back to work. What's more important is making sure those people are getting paid more. So to be interesting, Friday we'll have February's jobs report to see how that number is. Ryan has a quote going back when he first joined the firm. It's not so much the actual jobs report, it's the revised number for the previous 2 months before. And that's something that we always look at because there's always revisions. So this jobs report will be real important because it'll kind of dictate what the Fed may or may not do when they meet later this month. And equities, as Marty pointed out, are fairly valued. They had the potential to move higher with the earnings we had going back to the beginning of 2015, 6 quarters where earnings were on a downward trend, and then all of a sudden the third quarter earnings, which were released in the fourth quarter of 2016, were positive. The fourth quarter earnings of 2016, which We're really right now in the middle of the earnings season, have been positive. That's good news for the stock market. And we'll continue to be cautiously optimistic. What we look for is the fundamentals of the economy, corporate America earning money, selling more goods and services. That's all good news for the stock market. President Trump has been good news for the stock market. A lot of people would have never thought this. People thought we would never recover with Donald Trump being elected our president. We've had such a great rally in the stock market, as all three of my colleagues pointed out, because of the optimism, the policies that he's talking about, surrounding himself with business people in Washington, is all good. And this is why the stock market looks to be a good place to be invested over the near term, and we think that will continue. Although, because we've had such a great rise, and I'm not talking just since Election Day, we've tripled the value of investments since the Great Recession ended March of 2009. So that's been a really great run, but right now things look to be pretty good. We'll continue to watch it.